Not just in Washington, but all around the country, millions of economists, their finances are in a shambles. They're losing money every day. Their portfolio's underwater. Their interest expense exceeds interest received. They have the printing presses and they're losing money. If I had the printing press, I think I could make money.
Financial managers and economists are warning that the stock market and the housing market are in the greatest bubbles that the world has ever seen. And if you don't play your finances right, you may miss out on the opportunity of a lifetime and instead potentially become bankrupt. Now, we're going to talk about how this everything bubble may impact you, and we're going to ask the question, should we risk our money right now to try to make more money in this bubble? I mean, everything is at an all-time high after all. We're also going to review a new updated home price crash map using Zillow's home price forecasting. So they're going to forecast from now into 2026. And we're also going to go over a map that shows the year-over-year home price decline data. And we're also going to discuss why it's so important to pay attention. We're also going to discuss why it's so important to pay attention to institutional investors in the housing market becoming net sellers. But before I begin, welcome back to Real Estate Mindset. You guys already know this video is going to be absolutely bonkers. Mitch Vexler, sir, how are you today?
Everything is okay. I was just watching the market, and at the open, NASDAQ just took off straight up, literally a parabolic move on a 5-minute chart. And I still think that 24,000 is probably the ultimate target for NASDAQ. So we'll see how that goes. Gold and silver are kind of sideways. It's almost as if they're watching what platinum is doing, and platinum's on a bit of a pullback for a couple of days, but eventually the metals are just going to keep running. So it's an interesting market. And US dollar at the moment, there was a short squeeze starting really Sunday night. So the foreign currencies, euro, Japanese yen, Australian dollar, Canadian dollar are down while the US dollar is up. How that plays out over the long haul, nobody knows. But it's an interesting market.
During the course of this video, we're also going to listen to a few economists and a few financial advisors and even government officials that are going to give their opinions on what's happening in the economy. So let's finish up the first clip that you guys listened to in the intro.
Larry, good afternoon. I think they should go through all those items and more and think about it. The Fed is the house. It's a casino. The casino doesn't lose money. The players are the ones that lose money. And I'm not going to comment. I'm like you. I don't really understand what's going on with the size, the scope, the cost of the building renovations. One can ask, was it a good idea to start the renovations for an enterprise that's losing $100 billion a year? So 100 billion because of a mismatch in the bond portfolio from the short-term rates. And I think that the Fed should undertake an internal review, because I think all the other operations are endangering its independence of monetary policy. As I've said, monetary policy should be kept independent. It's a jewel box, should be walled off. But by undertaking all these other activities, then you come in for criticism, just like you're seeing here, that might impinge on monetary independence.
This article just came out titled "Famed Market Bear Albert Edwards Warns of an Everything Bubble in Stocks and Home Prices That Could Soon Pop." Albert Edwards, famed for calling the dot-com bubble leading up to the 2000 crash, is again warning investors of a potential painful plunge ahead, citing again, we are in an everything bubble. Stock valuations are indeed steep. The Shiller cyclical adjusted price to earnings ratio sits at 38, one of the highest levels ever. Both the trailing and forward 10-month PE ratios of the S&P 500 are historically high. To Edwards, this doesn't sit well with the fact that long-term interest rates have been on the rise. Rising long-end government bond yields tend to weigh on stock market valuations, and investors can find attractive returns without taking on the high-level risk in the stock market. Yet, U.S. stocks have seen a robust rally despite these things in recent years, gaining 78% since October 2022 lows. The market's high valuations have kept future estimated equity market yields low. When stocks are more cheaply valued, they can expect higher future returns. And obviously, as we're seeing right now, vice versa. It is notable how the US equity market has been able to sustain nosebleed high valuations despite longer bond yields grinding higher. I don't expect it to be able to ignore it much longer. And it has been amazing how it has essentially ignored it so long. And when I say amazing, what I'm also saying is inflation, right? Inflation or dollar debasement. This is very interesting. The US is the only market in which house price to income ratios have not derated since 2022. Is the US housing market also exceptional relative to Europe? No, it's nonsense. And in time, investors will come to claim they knew it all along. And you guys are seeing these investors start to flip already, saying, oh, I knew this was going to happen the whole time. I'm sorry for suggesting you buy a house, and I'm sorry that you just committed financial suicide at my advice. That's essentially what they've done. As for what could cause the potential bubbles in U.S. stocks and home prices to bust, Edwards said to watch. This is surprising. Japan. Higher inflation in Japan could mean higher interest rates and a further unwinding of the Japanese yen carry trade, in which foreign investors borrow cheaply in yen and convert it to dollars to buy higher yielding U.S. assets. In 2024, the Bank of Japan unexpectedly hiked rates, rolling global markets as investors liquidated assets they had bought with borrowed yen. In May, Edwards warned rising interest rates in Japan could cause a global financial Armageddon.
Momentum in the market right now. There's a lot of liquidity. Financial conditions are now as loose as they were when rates were near zero, and Trump is trying to force the Fed to lower interest rates, which is probably going to continue to fuel markets higher. But at the same time, you have a equity risk premium at the lowest level in decades, and 10 stocks that make up 40% of the S&P 500. And so if you're a risk taker, buying the dips here, and maybe we get that weakness in fall. And if you're not, and you want to protect your portfolio, just be a little careful out there, and don't get caught in the FOMO.
He's warning investors that, hey, come fall, more than likely stocks are going to go down. We're also going to read information that states that more than likely in August, as far as seasonality, the stock market is going to go down. But my question to you, Mitch, is as far as investing in the stock market, everyone knows it's all-time record high, massive bubble. There's no fundamentals here, but there's so much money. Should mom and pop invest in it? Is it risk on or is it risk off? And why or why not?
People who have the ability to trade intraday don't care, right? You're going to take a momentum trade based on what it is that you see in the chart, and you're going to set your stop below your entry bar, be it a 5-minute or 15-minute or 30-minute bar. So you're capping your risk. That's on an intraday basis. The intraday is the fractal of the larger time frame. So if you say, okay, I'm a day, that's in a 1-day, 2-day, 3-day swing trader, then you're going to look at that, but your charts are going to be the exact same thing, just on a larger scale. The problem is that the vast majority of people who are in the market can't read a chart. So as that gentleman said, FOMO, which is fear of missing out, so they end up with bad entries. They don't understand how to quantify their risk, which is how many contracts they would be trading. And then they end up taking, in fact, what could be a losing trade because they didn't understand what it is that they were doing. And I mean, truly understand and be able to trade it, set your risk, quantify the amount of contracts, et cetera. So on a short-term basis, if you can trade it and you understand it, perfectly fine. On a longer-term basis, if you're looking at this, it's not your job to judge what you think. What you think isn't relevant. The only question is, where's the momentum? So if the momentum keeps going, which in the case of NASDAQ, it is at the moment, and 24,000 is probably the reasonable target, but realize we're at all-time highs. So you're entering the market at an all-time high. And Besant was right, it's a casino. So look at the amount of money that's been printed by the US Treasury, which is in the trillions, 26 trillion from the prior administration. That money ended up going in the market. And what it does is it creates a very muddy look at what's really happening, because it gives you the illusion that the market is super strong. Look at all this money and look at the stock market, but none of it matters. All you have to do is look at the median household income of mom and pop and see that they can't afford the roof over their head. And that affects 42 million people across the United States. That's the truth. That's the big number. And that's what nobody on the government side wants to focus on. And that's why we are where we are. So trading it, you have to be extraordinarily careful. You've got to know what you're doing.
If you're a normal mom and pop, normal person just like me, and you're not a massive intraday daily trading expert that has caps on all of the liabilities and risks, then stay the heck out of the market. I'm not suggesting people do this, but I've liquidated my 401k, and there wasn't a lot of money in there because I no longer work for a mortgage company, and I had a 401k, and I've invested in silver, and so far it's been a slam dunk of a decision. But that's for me personally. Now, that may not be the case for everyone. Now, what I want to do is go over 3 red flags that investors should be paying attention to that are investing in the stock market. 3 red flags investors need to be aware of. And again, this is from Zero Hedge. This came out on Tuesday, July 29th. And this is what this is saying. As I warned yesterday, this market rally is extremely tired. Stocks have gone straight up for 3 months through to peak. The S&P is up over 30%. It has gone over 60 days without touching its 20 DMA. This is not normal market action, and a consolidation, if not a correction, is long overdue. Indeed, the last time the S&P 500 had a streak like this was during, the dot-com bubble. Numerous red flags are now pointing towards a pullback hitting. First and foremost, high yield credit, which typically leads stocks. Note the red line led the black line during this recent rally, has already began to roll over. And you guys can see that again in both the black line and more specifically in the red line right there, already, as this is pointing out, turning over. Secondly, another matrix that typically leads the overall index has began to roll over. Here again, this is a red flag that a pullback is coming shortly. So again, they're trying to show that right here, the red line going down slightly. Finally, seasonals and historic trends are favoring a pullback. So you have all this economic turmoil, overvaluation, and on top of that, seasonality. As Ryan Dittrich notes, August is typically a weak month during the second term of a president. The average return is down 3.4%. And this is very interesting. This is showing you guys what happened as far as the S&P 500 returns in August. Here's Eisenhower in the year of 1957. In August, it went down 5.6%. Nixon down 3.7%. Reagan down 1.2%. Even Clinton down the biggest 5.7%. George Bush down 1.1%. Obama 3.1%. And now they're waiting on, of course, Trump.
To learn to go around the dollar. I think the President Trump has done a very smart move against the BRICS, what they were trying to do. But it all comes down to debt. That's why debt is our greatest threat to America. And you cannot avoid it any longer. The next president is going to have the debt crisis. And this is where Congress, and the challenge is, if you looked in the past, the Democrat had the blue dog. Those were Democrats who cared about debt. They're no longer there. No one in Congress has got elected saying they're going to balance the budget. The country has to be educated on this, and Congress is going to have to act, because Social Security in the next administration is either going to take a 24% cut or do something about it.
I like what he said, Mitch, when he said that society needs to learn what's really going on. I couldn't agree with that more. The apathy is absolutely brutal. But if I can, what do you think the biggest warning sign is that investors should be watching regarding the stock market? What's the biggest warning sign?
In reality, watch the foreclosures. The increase in foreclosures will be the foretell to what the stock market does. So it's really 2 things. As the foreclosures ramp up, you'll see it in your own neighborhood. You'll see the stores starting to go vacant. You'll see that mom and pop aren't able to make their payments, be it on the houses or the properties that they own. And that also goes for the institutions. So that's one item. The second item is a reverse bear bar at an all-time high. When you get an outside bear bar, there's your warning. And then you'll have time still to enter. You don't necessarily have to pull the trigger that second. But when you get on a daily chart, 2 legs, 1 leg, pull back, second leg, and it keeps going, that's your entry. That tells you that the market's headed down. So give or take, it's about 10 days. And further to the point, education of yourself. If somebody wants to trade and learn, it's a very interesting process, because you learn not just what the market is, but you learn what your psyche is. And your psyche will tell you what it is that you're good at. There are some people who are good at options. There are some people who are good at stocks because for whatever reason they were around it when they were a kid. They seem to have a understanding of it. So you've got options, stocks, futures with options, different things you're good at. But here's the underlying point for the average person. If you could just simply say, my goal for the sake of conversation is $100 a day. Well, that's $2,500 a month. All of a sudden, that's not such a bad little nest egg / kitty to help pay for food and clothing. Just things around the house in general. That takes a fair amount of pressure, depending on the income level of that party, but it takes a fair amount of pressure off because be it $100, if your median household income is 70 or 80,000, that's a fair amount. If your median income is 150,000 and you're able to do $300 a day, not bad. So learning and taking the time necessary to learn what the market is and how it can generate a little bit of extra cash for you puts you in a whole different perspective of life.
Mitch, what if I'm good at freaking out and hitting the panic button? What should I invest in then?
A book on psychology on how not to freak out.
Very good, very good.
I mean, it doesn't do anybody any good. People, when they panic, your brains, it's called fight or flight.
Yeah.
So your brain kicks in that is trying to protect you, but it does have a very negative effect if you're doing that in the marketplace because you panic.
Yes.
You just simply can't think straight.
Right.
And so it doesn't do anybody any good. And again, that's a psychological issue, right? Reality is different than psychology. So learning about what's happening around you and watching the signs. You can drive down the road and see what's going on. You can drive into a subdivision, go and count how many for sale signs there are. That'll tell you what's going on.
Well, speaking about driving in subdivisions, looking at how many sales are going on, let's move on to Zillow's housing market crash map. Zillow updates home price forecast for over 400 housing markets. See the map. So the first thing is we're going to look at their forecast. Okay, so this is what they think is going to happen. Now, Zillow's forecast for metro level home price change between June 2025, so basically about right now or last month, and then 1 year out from that. And what you're going to notice, first thing is I don't see any blue marks. I mean, I see a little bit here on the East Coast, like right here in Atlanta City. And then a little bit right here, look at here's Edwards, Colorado. But this map is littered with housing markets and metros that they believe are going to experience home price decline. Remember when this whole thing was blue? And again, in all fairness, there's a couple little places around here, little places in between with blue, but look at the overwhelming amount of home price decline. They're thinking pretty much the entire West Coast is going to have home price decline, as well as the Panhandle right here, Louisiana, Texas, Florida. Look at this, guys. Absolutely littered. Here's the top metros that they think are going to lead with home price decline. And the shocking thing that you guys should notice pretty much right away here is the first 6 metros are in Louisiana. First one, Houma, Louisiana, I think. I've never even heard of that, down 9.6%. Lake Charles, down 9.5%. Alexandria, -8. That's huge. Those are huge price drops in 1 year. New Orleans, 7.2. Lafayette, number 7. Get to Texas. Beaumont, Texas, not even Austin, down 6.5%. And then California, number 8. San Francisco, 6.1. Then Austin, 5.1. And then Corpus Christi. Wow. Have you guys ever been to Penn's Padre Island? Beautiful there. Down 5%. And here's the 1 year change for metro areas right here, guys. So this is the active data. Obviously, Florida looks like pretty much leading this year. Okay, Melody, Wright, and I have a bet, but Florida definitely in distress. Massive home price decline all over Florida, especially in condos. All these little areas right here as well, which we toured. Melody, Wright, and I took you to these areas to show you, hey, there's massive new construction pockets. Those new construction pockets and concentrations will hurt the housing market. Here's Phoenix right here. I mean, the housing market absolutely being devastated right now, except the Northeast. Look at the Northeast. Absolutely shocking that the prices are still going up. Before ending us out, let's listen to one more video about how there's accidental landlords and institutional investors turning into net sellers. Take a listen.
Harder to sell a home with persistent high prices, high mortgage rates, economic concerns weighing on the consumer. So sellers are trying a new tactic that could have a big impact on some investors. Diana Olick has the details in today's Property Play. Hi, Diana.
Hey, Morgan. Yeah, frustrated sellers reluctant to lower their prices anymore are instead putting their homes up for rent, so-called accidental landlords. And there are so many now, they're actually starting to affect rental supply and the big institutional landlords. The largest investors owning more than 50,000 homes are highly concentrated geographically. Invitation Homes, American Homes for Rent, and Progress Residential each hold over a third of their assets in just 6 U.S. housing markets, according to Parcel Labs. These markets have seen rental inventory growth of well over 20% in the past year, much of it from former owner occupants, like Garrett Johnson, who bought a home in Dallas 2 years ago, but was recently transferred to Houston. He tried in March and April to sell his home, dropped the price a few times, but crickets. So he decided to rent it and immediately got several offers.
I expect to hold it until the market recovers, whenever that is. I don't expect for it to recover super soon. So, the expectation is that it'll be several years.
The concern for the big investors, according to Mizuho analyst Handel St. Juste, is that the big landlords who have been getting 4 to 5% rent growth in their renewals and 75% retention in their portfolios won't be able to sustain that. Those big landlords have already become net sellers of individual rental properties and are instead turning more to the build-for-rent communities.
Mitch, at this point, you'd have to be living underneath a rock or intentionally choosing not to listen to think that home prices aren't going down anymore. Also understanding that the housing market is bifurcated. But Austin home prices are down 20% from peak. Those people that purchased at peak are devastated. Maybe not on the East Coast yet, but the pendulum in the housing market is swinging. It's swinging violently. We have a home price crash that's incoming. I believe we need to be protecting our purchasing power to take advantage of great opportunities that are incoming. But my question to you, Mitch, and this may be even more telling, what does it tell us about institutional investors becoming net sellers in the housing market? What does that tell us about the state of the housing market?
Well, it tells you that Zillow and the institutional build to rent, that's called BTR, players have painted a picture which is an illusion. So your quote was, Zillow believes are going to experience home price declines. Okay, no one should care what anybody believes. If you can't quantify it, you have no business whatsoever stating anything, or you're stating it to paint the illusion. And the point that I'm getting at is that nothing matters other than the median household income because it's quantifiable. So the math, from a formula standpoint, the math must be below 28 debt to income ratio, ideally closer to 21, which is the math that we ran in order to take into account the inflation. And that is how you determine the affordability of the average home. That's your bogey. In other words, you painted an illusion, you blew the market up several fold over and above what the house is actually worth, and now it's coming down. Well, it's going to stop somewhere between 21 DTI and 28 DTI. That's what's going to happen because mom and pop only have so much money. The house is only worth so much based on the median household income. Then with regard to the build to rent, many of these entities, BlackRock, get 2% of assets under management and 20% of the profits. They're a private equity firm, basically. Well, private equity has got its own problems, and we'll not go on to the criminal side of things, but the bottom line is they're there for the share price. They don't care about the asset. They don't care about the tenants. They don't care about anything. For them, it's pure share price. What can we state and get away with in the press to drive our share price up? The reality is that the BTR properties are generally built and perform it out on a 6 cap. That means 6% all rate of return on cash. Well, reality is closer to 4. So mom and pop gets suckered into this stuff saying, well, it's built to rent and multifamily has got a 4% increase this year. It's not true. You can have it but you've got to go back and look several years. What was a median increase? And then you've got to go back and look at the median household income. How much can my tenants afford? Well, interestingly enough, on a 4-cap property, do you realize that those things are being built with 70% credit risk, meaning 70% of the tenants can't afford to live there? Again, we come right back to where I started this section on that 21 to 28 debt to income ratio. That's your bogey. That's where the market's going to slide to. That's how you know when you can get in and buy something. As Travis says, when you've got wedge, that's where it's going to be. It's going to be in that 21, maybe 23 DTI. That's what's happening.
For the viewers that want to get an update on what's happening with the civil rights violations and our battle against the Central Appraisal District in Montgomery County that assault and battered me, kicked me out of the building, and then trespassed me, don't forget, you guys, you can go here. I have a special tab called Tax Protest Criminal Complaint. Everything is here. I updated this as well. 2 more updates on the 24th and the 28th. And then today, you guys, I'm meeting a media organization right in front of the Central Appraisal District because yesterday we finally got the trespass removed. And a big shout out, big thank you to the county judge, Mark Keogh. Sir, thank you for being a patriot and caring about your constituents and caring about the people and business owners and every single resident in the county and community you live in. Appreciate that, sir. Now, other than that, guys, don't forget, go and learn. Go to our websites and learn. And if you guys are out there just investing in your life, investing in real estate, the stock market, trying to figure things out, you guys already know. We wish you luck and we hope you win.